Marginal costing is a powerful decision-making tool in cost accounting, primarily concerned with variable costs and their behavior in relation to production volume. It isolates fixed and variable costs to assess the profitability of each additional unit produced. Break-even analysis, on the other hand, is a crucial tool for identifying the sales level at which a business neither makes a profit nor incurs a loss. Understanding the break-even point helps managers determine minimum performance requirements and set realistic targets. In this module, you will explore the concepts, applications, benefits, and limitations of marginal costing and break-even analysis. Emphasis is placed on real-world decision-making, cost-volume-profit relationships, and graphical representations for enhanced managerial insight. By the end of this module, you will be able to explain the principles of marginal costing, differentiate between marginal and absorption costing, compute contribution margin and understand its strategic importance, analyze cost-volume-profit relationships, determine break-even points in units and value, interpret break-even charts and margin of safety, apply marginal costing to decision-making scenarios, make or buy, pricing, shutdown. Core concept of marginal costing. Marginal costing is a costing technique that considers only variable costs, also called marginal costs, in product costing and decision-making, while treating fixed costs as period costs charged in full to the profit and loss account. Key elements. Variable costs directly vary with production, e.g., raw materials, direct labor. Fixed costs do not vary with volume, e.g., rent, salaries, depreciation. Contribution margin equals sales minus variable costs. Profit equals contribution minus fixed costs. Marginal costing equation. Profit equals open parenthesis. Sales minus variable cost, close parenthesis, minus fixed cost, equals contribution minus fixed cost. Contribution margin analysis. The contribution margin, CM, is the surplus remaining after variable costs are deducted from sales. It contributes to covering fixed costs and generating profits. Types, period. Unit contribution margin equals selling price per unit minus variable cost per unit. Contribution margin ratio equals contribution divided by sales times 100. Importance. 1. Measures profitability of individual products. 2. Guides pricing and product mix decisions. 3. Useful in break-even and CVP analysis. Marginal versus absorption costing feature. Marginal costing, absorption costing. 1. Cost included, only variable costs, fixed and variable costs. 2. Inventory valuation, lower, excludes fixed OH. Higher, includes fixed OH. 3rd. Profit impact, profit varies with output, profit may remain constant. 4th. Suitability, short-term decisions, long-term profit measurement. Break-even analysis. Break-even analysis determines the sales level at which total revenue equals total costs. No profit, no loss. It helps managers understand how many units must be sold to avoid losses. Break-even point, units. Break-even units equals fixed costs divided by unit contribution margin. Break-even point, sales value. Break-even, sales value equals fixed costs divided by contribution margin ratio. Break-even chart, graphical representation. A break-even chart displays fixed cost, horizontal line, total cost line, fixed plus variable, total revenue line, break-even point, intersection of total cost and revenue, profit and loss zones. Visual tools like this enhance understanding of cost structures and sales thresholds. Margin of safety. The margin of safety, MOS, represents how much sales can drop before reaching the break-even point. It is a risk indicator. Formula: point MOS equals actual sales minus break-even sales. MOS percent equals open parenthesis. MOS divided by actual sales close parenthesis times 100. A high MOS indicates better financial health. Applications of marginal costing in decision-making. Make or buy decision. Compare marginal cost of in-house production versus purchase price. Special order pricing. Accept special orders if price covers variable cost and contributes to fixed costs. Shutdown decisions. Shut down operations temporarily if losses are reduced or contribution is negative. Product mix optimization. Maximize total contribution by allocating resources to most profitable products. Profit planning. Set sales and production targets based on contribution margin and fixed cost coverage. Limitations of marginal costing and break-even analysis. Not suitable for long-term pricing. Assumes linearity of costs and revenue. Ignores step fixed costs and capacity limits. Less accurate when product lines are diverse. Break-even charts are simplistic in complex environments. Illustrative example. A company sells a product at 1,000 naira per unit. Variable cost is 600 naira, and monthly fixed costs are 400,000 naira. Unit contribution equals 1,000 minus 600 equals 400 naira. Break-even units equals 400,000 divided by 400 equals 1,000 units. If actual sales equal 1,400 units, margin of safety equals 1,400 minus 1,000 equals 400 unit.